It's Tuesday, 4th of March, and this is your Capital Economics Weekly Briefing. An extra episode this week, an emergency podcast they like to call it, because we're just hours after the Trump White House announced more tariffs on China, new tariffs on Canada and Mexico. Coming up, we'll be hearing about the implications for those countries, but first, Group Chief Economist Neil Shearing joins me to make sense of what's going on. Hi, Neil.
Hi, David.
I asked you this question about a month ago when the initial tariffs were announced, and then those tariffs were suspended, but they've come into force as of midnight Washington time yesterday. The question I asked a month ago was, is this the start of another global trade war? I'll ask it again.
Well, back then I said I didn't think we were at the start of a global trade war. I still think that's probably the case. Global's the key part here, but I think this is the start of a US trade war, potentially. The reason I say that is that when we spoke a month ago, I said actually our assumptions on tariffs baked into our forecast were a bit more aggressive than the consensus had assumed. We were baking into our forecast the idea that tariffs would rise further and faster than most sell-side analysts, but that other countries would respond in a relatively contained, measured way, designed and calibrated so as not to escalate the situation. Now, other countries, they've pushed back, but they're doing so in a way that's perhaps not quite as aggressive as the US measures. And of course, they're not imposing protectionist measures on one another. This is just in retaliation to what the US is doing. So at this juncture, I would say it's a US trade war. It's not a global trade war. And of course, the critical question really is, to what extent are the tariffs on Mexico and Canada permanent, particularly Mexico and Canada, because they're long-standing US allies? To what extent are they permanent, or to what extent do they get rolled back, either as any part of any renegotiation of USMCA agreement or in exchange for concessions elsewhere?
The other point, though, is that the more tariffs are coming down the pipe. We've got these reciprocal tariffs, meant to be a decision made on those in early April. Trump has spoken about European Union tariffs on US auto imports, for example. He's identified other sectors that are now subject to trade investigations. So when we talk about whether or not this is the start of a global trade war, I guess the question really is, are we seeing a rollout of much broader and much higher tariffs across countries, across sectors?
Yes, that's a really good point. The justification for these tariffs, of course, was in response to the flow of fentanyl across the border in North America and also migrant flows into the US. So it was about border security and fentanyl. This is not about reciprocal tariffs, which are coming down the pipe, as you suggest. And it's possible that those reciprocal tariffs stack on top of the tariffs that have been announced over the past 24 hours. So I think further tariffs, yes, coming down the track, but again, they're coming from the US on US trading partners rather than at a global level. So again, I still think this fits with the characterization of a US trade war rather than the global trade war. Now, that's not to underplay the importance or significance of this. This is a big shift. I think it's particularly a big shift given everything else that's coming alongside. At the geopolitical level, the pausing in support of the US for Ukraine. And at a domestic level, this has come alongside further signs that the US macro data is deteriorating. Lots of focus on the Atlanta Fed's GDP nowcast, now pointing to a pretty substantial contraction in GDP in the first quarter. And if you look across the board, across the data, actually, it's weakened significantly over the past week or so. So domestic economic troubles, bigger geopolitical fissures between the US and its allies, and those tariffs add to the kind of sense of uncertainty prevailing over the global economy.
These macro vulnerabilities that you've just spoken of, then we discussed them on the last podcast as well. Even more noises now, just a few days later, about weakness in the US economy. Could this lead to the Trump administration backing off some of these tariffs? As you suggest, there's uncertainty about how long these could remain in place. And given how much of this is reliant on the whim of one man, there's every possibility, isn't there, that in a few days we'll be in an entirely different world in terms of trade policy?
Yes, you get the sense, don't you, reading the media reports and looking at some of the leaks that have come out from Washington over the past 24 hours or so, that several members of the administration were, if not pushing back substantially against these tariffs, that were at least more skeptical than Trump, but President Trump's the person that has pushed these through. So you're right that this kind of hinges to a large extent on the whims of one person. And I think it's important, as I said before, not to underplay the significance of these tariffs and the broader developments over the past week or so. I mean, just on the tariff front, if you look at what's happened to the effective average tariff rate in the US over the past month or so, it's increased to levels not seen since the end of the 1940s, according to our estimates. So this is a really big shift. The question, as you suggest, is will this be sustained? Because on the face of it, that this has the potential to do a significant amount of economic damage to the North American economy, and also is going to aggravate US inflation at a time when, all other things being equal, the Fed might be thinking about trying to loosen policy and lower rates because of a weakening macroeconomy. Actually, according to our estimates, if these tariffs stay in place, we think PCE inflation will be back above 3% by the third quarter of this year. So inflation heading up at the time when the macroeconomy is weakening is a pretty ugly mix. And so, yes, I think as the reality of that starts to play out, perhaps it is possible that some of these tariffs get rolled back. By the same token, the other side to that, though, is that the administration is trying to push through tax cuts, and it might well be that the tariffs are being viewed as a new permanent source of revenue that would make space for additional domestic tax cuts. And if that's the case, it's going to be much more difficult to row back on some of these tariff increases. So lots of uncertainty. A lot of it does, as you say, hinge on one person, but there's also factored into the mix that we need to consider the extent to which tariffs are being considered a new source of permanent revenue. And if that's the case, then it's going to be more difficult to roll them back.
That was Neil Shearing on the global and US picture in light of these latest tariff announcements. But what does this mean for those countries that have been targeted? To find out, I spoke to Julian Evans-Pritchard, our China Economics Head, and to Deputy Chief North America Economist Stephen Brown and Chief EM Economist William Jackson about the implications for China, Canada, and Mexico in that order. Here's that conversation now, and it starts with Julian talking about where tariffs are on Chinese imports into the US.
Yeah, so we started off Trump's second term with the average US tariff rate on China somewhere in the region of around 15%. That's now up above 30%. So we've had a 20% additional tariff hike on Chinese goods. And to put that into context, that's larger than all of the China tariffs that Trump imposed during his first term. So we've already exceeded that benchmark. We don't think it will necessarily end there. There's obviously the talk of reciprocal tariffs coming in April, which could target China. There were some comments from Trump today specifically singling out China for its exchange rate policy, and that's one of the factors that they're going to take into account for those reciprocal tariffs. There's also a separate review in the US of trade relations with China that's also due in April that may come with some recommendations around further tariffs, including potentially ending the permanent normal trading relations with China, which would involve a further increase in tariffs on China as well. So most signs point towards some further escalation. We have embedded in our forecast actually quite a hawkish view on tariffs, that the US tariff rate on China will go all the way to 60%, which is what Trump threatened on the campaign trail. So we're on the more hawkish side of the consensus in terms of our tariff assumptions, but at the same time, we are anticipating a pretty substantial exchange rate adjustment with the renminbi going to 8 against the dollar, and that helping to offset much of the impact of tariffs. Now, so far, that hasn't happened. Actually, the renminbi has been incredibly stable. In trade-weighted terms, it's no weaker than it was on the day of the US election. So they have not really allowed any exchange rate adjustments so far. And if that remains the case, then potentially the impact of these tariffs could be larger than we're currently anticipating. So at the moment, with no exchange rate adjustment, we estimate the impact of the tariffs so far is a hit to Chinese GDP of around 0.4%. So still fairly modest, but it's certainly not nothing. And it's obviously not a drag that Chinese policymakers would rather not have at the moment, given all the other headwinds that they're dealing with.
Does the fact that the exchange rate hasn't really moved, that the PBOC hasn't allowed it to depreciate, does that speak to the sort of the broader Chinese response we've seen so far? And could we see that approach change, perhaps become a bit more aggressive?
If you use the first trade war as a gauge, it was noticeable that initially they kept the renminbi pretty stable, but that as tariffs escalated, they did eventually allow a more substantial adjustment. If that's the model, then at some point they could change their approach and we could start to see more renminbi weakness. And that's on the assumption that for now, they're trying to avoid antagonizing the Trump administration and keeping the renminbi stable in the hopes that there'll be some negotiation that maybe rolls back the tariffs or at least prevents further tariffs from coming into force. But if those negotiations don't really come to fruition, then they might throw in the towel and let the currency depreciate. So that's one scenario. But I think, there could be domestic considerations here as well. At the start of the last trade war, the renminbi was a lot stronger than it is now. It's already at a historically quite a weak level. And we know that the leadership in Beijing don't like to see the currency depreciate too much. So there's potentially some domestic political considerations as well that are influencing their exchange rate response. So it's not entirely clear whether we will get that exchange rate offset, but for now, we're assuming that eventually they will allow that to happen.
What about other countermeasures like blocks on American goods or making life much harder for US firms in China? Do we see that stepping up as well?
So far, they have been taking countermeasures both in response to the latest tariffs and also the 10% tariff hike that came in February. In both cases, we saw some tariffs on US goods, although much smaller in scale than the US tariffs in the other direction. Back in February, they put tariffs on around 20 billion worth of imports from the US. This time, you're looking at something similar, focused mostly on agricultural products. And then on top of that, they've also been targeting individual US firms. So today, they announced that 10 US firms will be added to their unreliable entities list, and 15 will be added to the export controls list. So in both cases, just makes it a lot harder for Chinese companies to do business with these firms, prevents Chinese companies from exporting dual-use products, that sort of thing. So I think that the goal here is to really send a message that they're not going to be pushed around, but at the same time, calibrate their response in the hopes of trying to avoid escalating things further. So it's a sort of calibrated response. I think that if tensions escalate further, there's a lot more that they could do. There's obviously a lot more US firms that they could target. They've so far mostly focused on defense-related firms, but there are much larger potential targets, Apple, Tesla, the likes. So they definitely could escalate things further.
Stephen, let's turn to you. We've heard about how China's been hit. We've heard about the Chinese response so far, slightly cautious in its approach, perhaps bracing for more tariffs to come in, calibrating perhaps a tougher response if that happens. What's the view from Canada? Is that a similar sort of message?
Canada's certainly gone relatively hard, I would say. So they've already announced retaliatory tariffs on 30 billion worth of imports, which isn't huge yet, but they'll follow that up with another 120 billion tariffs on another 120 billion of imports in a few weeks' time. So that would cover essentially a quarter of their imports from the US. And those measures would be targeted at Republican states, so designed to inflict the most political damage. There is a limit to how much Canada can do because trade with the US is worth much more proportionally to the economy. So if Canada were to fully retaliate, then that would push up domestic inflation considerably and limit the extent to which the Bank of Canada could ease the burden with looser monetary policy. But certainly they have also talked about other measures. So in Ontario, Doug Ford, the provincial premier, has talked about cutting off electricity exports to the US. And there has been some talk about potentially cutting off oil exports too, although that does seem to lack the political will in Alberta, where most of the oil was produced. But certainly they are trying to send a political message here, at least to Republican states, to try and exert some influence on President Trump.
Are we expecting tariffs to go higher from here? Where are tariff levels for Canada at the moment?
President Trump has imposed it's a 25% tariff on all imports from Canada, aside from oil exports, energy exports, which have a lower 10% tariff. But that lower 10% on energy exports is offset to some extent by higher tariffs elsewhere. For example, steel and aluminium exports to the US are going to face a 25% tariff, which is due next week, which will be on top of these 25% tariffs announced today. And yesterday, the Commerce Department also confirmed its intention to raise tariffs on lumber imports from Canada even further. So certainly there's a lot of pressure already. There is a risk that these tariffs would stack on top of any existing ones under the reciprocal trade plan that is likely to be announced next month from the US, although There has been some talk from the US side, some speculation at least, that the complexity of that plan means they'll take it on a country-by-country basis. So perhaps these tariffs are almost in place of those reciprocal tariffs. But certainly, even at this level, if these tariffs of 25% are sustained, then it's extremely likely that the Canadian economy will fall into a recession this year, even with some fiscal support to offset the blow.
What about the BOC? How does this affect its strategy?
Yeah, it is a bit of a tough call for the Bank of Canada. So it's weighing up the upside risk to inflation against the downside risk to GDP growth. I think, though, it's quite obvious that the Bank of Canada will land on the side of loosening policy in the face of weaker GDP growth. For a start, if we think a central bank needs to be forward-looking, these tariffs are going to boost prices for when they come into effect, they'll boost prices. Maybe they'll have some indirect effects if they boost inflation expectations. But in the background, this huge hit to demand from potentially much weaker export demand, potentially layoffs, much weaker labor market, that's going to drag down inflation elsewhere. So I don't think the bank's going to be too concerned. I think its base case will be to loosen policy. So we've got a Bank of Canada meeting next week where we will get, at the very least, a 25 basis point cut, if not perhaps even another 50 basis point one. And then at the moment, our forecast had been that the bank will stop at 2.5% for the policy rate, which would imply another 50 basis points of cuts from here. But I think it would have to cut lower that to at least 2%, if not even much lower, if these tariffs did remain in place.
William, much the same questions, really. Where are tariffs on Mexican imports into the US now? What is the macroeconomic impact of this? How bad could this get?
So in many ways, the situation for Mexico is similar to Canada. It's facing a 25% US import tariff on all its exports to the US. It hasn't had a carve out for its energy exports, which Canada has. Those for Canada, those are only facing a tariff of 10%. But Mexico will also face additional tariffs stacked on steel and aluminium exports to the US. And we've heard talk of potential US import tariffs on the auto sector more broadly. If those are added to the tariffs Mexico faces, then that will significantly raise the tariff rate that its exports face into the US, given the importance of its auto sector and its auto trade with the US. So while hard to put numbers on this, we see the 25% tariff that was announced, if that stays in place, that's likely to tip the Mexican economy into recession, perhaps a fall of about 1% in its GDP. But there's a lot of uncertainty here. And in particular, when we consider how complex and deeply integrated auto supply chains are with the US, they're passed across the border as much as 8 times before a car is fully assembled. If it's facing a 25% import tariff each time it's crossing the border, that could really cause significant disruption to these supply chains. We had been expecting significant falls in the Mexican peso that would help to offset these tariffs. We haven't seen that so far, which also suggests the impact could be somewhat larger. Up to this point, the Mexican government hasn't announced retaliatory measures, although it's clear these are in the pipeline. I suspect it's going to be relatively modest. In the past, they've tended to focus on agricultural products that are politically sensitive. I think the government's unlikely to look at widespread tariffs as a form of retaliation, particularly given domestic inflation in Mexico remains quite high. I had been of the view that the central bank would be wary about currency weakness and might stop its easing cycle in faced with tariffs. Given that we haven't seen a very large fall in the peso, I think it's going to remain on the dovish side. We're continuing to focus on the deteriorating economic outlook. So we could still see more 50 basis point interest rate cuts at the next few meetings. But where I think one of Mexico's weaker points is that there's limited scope for a fiscal response. We saw this big budget blowout last year ahead of the presidential election. Deficit went beyond 5% of GDP, one of the largest levels since the 1980s. And all the fiscal plans for this year envisage quite significant fiscal tightening. And they're having to do that at a time when they're facing this challenge from tariffs. So there's very limited scope for them to provide any offsetting fiscal support.
So of the 3 countries that we've been discussing, Mexico sounds by far the most vulnerable to what's been going on.
So it's very dependent on exports to the US. It hasn't had carve-outs so far. And I think the scope for that policy response to offset the economy is not there to the same degree as in Canada or in China.
William Jackson, Stephen Brown and Julian Evans-Pritchard on the latest tariff announcements. Look out for their written analysis on how these economies will be affected and how their governments will respond. We'll be doing a drop-in. That's one of our short-form online briefings all about the situation today. That's Tuesday the 4th. I'll add registration details to the show notes so you can watch the live event or the recording after the fact. Julian will be doing a drop-in tomorrow. That's Wednesday, the 5th of March. That's the opening day of China's National People's Congress. No doubt much discussion at that government get-together about these tariffs and the Trump administration posture. I will add the registration link to that event as well to the show notes. If you have specific questions about what US trade policy could mean for your business, then do get in touch. We've a global team of economists looking at country and market level impacts, but we also have a consultancy team that can address any issues relevant to your organization. Speak to your account manager to set up a meeting if you need any help on any of that. But until next time, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.